Good morning, everybody. Sorry, we had some technical difficulties just getting this going today. So I just want to introduce everybody and thank you very much for attending our webinar today. Just want to give everybody a few words before we get started. 360 Energy has been around since 1995, delivering continuous improvement for customers. By embedding management practices that measure energy and environmental costs, improve their controllable. We design and implement energy strategies in order to manage an organization's carbon footprint and avoid unnecessary energy costs. Today's presentation is part of an ongoing series of webinars that we're doing to keep corporate leaders objectively informed of the many changes, including risks and opportunities occurring in the energy industry. In today's webinar, we're very happy to have Schork of the Schork Group joining us. Stephen is a research analyst and trader out of the US who regularly reports for outfits such as the Wall Street Journal, Reuters, CNN, and Bloomberg, among many others. Stephen's distinguished by his skill in identifying pricing inefficiencies in among commodity markets. Through a multidisciplinary approach to trading and idea generation, Stephen blends these distinct disciplines to present a unique approach to market intelligence. Today, Stephen will address how COVID-19 and other recent events have disrupted not only Canadian oil and gas markets, but in the US, which also impacts us here as well. Before we get started, just a few housekeeping notes. During today's webinar, we'll be keeping our lines muted just so background noise doesn't interfere with the presentation. We do encourage people to use the questions feature in GoToWebinar to ask questions. So at the end of today's webinar, it's our intention to have a few minutes to answer some of those questions. Just a quick note on some upcoming webinars we have. We actually have one later today at 1 o'clock on distributed generation in Canada. May 20th, Heidelberg Cement from Northern Europe is going to be describing their path to carbon neutral concrete products. And May 28th, we're actually going to have a repeat of our zero emissions webinar for those that missed it. On our website, you'll find a list of our past webinars as well. So without any further ado, thanks so much for attending today. And I'm going to hand this over to Stephen. So thank you very much for joining us today, Stephen.
It's great to be here, Julie. I appreciate the opportunity. And so let's jump right into this at this moment. So clearly, and Don, this is not working. Oh, a moment. The advance, okay. Right, so the inextricable link between Canada and the United States. This is not just a Canada story. This is not just a United States story. Heck, it's not just a Mexican story. This is a North American story. This is a global story at this point. So what we're looking for is, next slide, please. Okay, so the US's role in here. Keep in mind that we're all now bearing the detriment of not just the demand hit by COVID-19, but it all started back in February on the supply side, even before the demand side took over. So at this point, what we were looking at here is the Trump administration decided back in February, about 2 weeks prior to the meeting, the OPEC meeting, OPEC Plus with Russia, to go ahead and sanction Russia's largest oil trading company. So what we were looking at here was a situation that evolved into, the next slide, please. Crude oil production. So what was Russia supposed to do? The United States is producing 13.1 million barrels a day, by far the largest oil producer in the world. US producers showed no sign of pulling back on their production. So when Saudi Arabia called Russia to cut production on the behest of the United States, Russia really had no choice but to go ahead and try and play the supply game and enter into the price war. Now, unfortunately for Russia, Saudi Arabia, the United States, Canada, and the world, this price war between Saudi Arabia and Russia, which again, the decision by the United States to factor into this play was the antecedent for this war, occurred right when the demand hits were coming from COVID-19. So at this standpoint, next slide, please. So at this, next slide, please. So at this standpoint, what we're seeing here is a massive hit in demand. Now let's keep in mind, North America was already in a recession, at least on the industrial standpoint. From an energy consumption standpoint, as we see here, intermodal demand falling 9.2% in March signified a significant hit to demand that was already encompassing. And keep in mind, this was clearly going on right before the COVID-19 hits. So as we see on the next slide, or actually on the next two slides, with the Chicago Fed National Activity Index, we're looking at a pullback in demand that we haven't seen since the Great Recession. And actually, we haven't seen demand hits like this, more or less since the last, the Great Recession, and then going back to the double dip recession, and of course, the Great Depression. As we can see on the next slide, from the American Chemical Council, this is their chemical activity barometer, which is a strong correlation to industrial production. We started to see a pullback in the demand for chemicals in North America that began back in January and February and was clearly signaling trouble ahead. I once again need to preface this, that all these hits were coming prior to the COVID-19 protocols. So as we see on the next slide, ladies and gentlemen, this is what a Great Depression looks like. Keep in mind, the United States, Canada, the world, we're not in recession right now. We are in depression. When we look back at the industrial production, the hit that we took in March, and keep in mind, this is March. This isn't even taking into account April, when all of the demand hits really hit from COVID. We saw here in the United States a pullback in industrial production, the likes of which we haven't seen since the 1940s, when the North American economies were deindustrializing after the buildup of World War II. To go back and see hits prior to this, you have to go back to the Great Depression of the 1930s, and then before that to the late 19 teens, early 1920s, when again, the North American industrial economies were deindustrializing from the wartime ramp up from World War I. Now, there's only two scenarios that are going to play out here. The first scenario is the good scenario. That is to say, this is 1920, and we're going to lead into the Roaring 20s. Or this is 1949, and we're about to lead into the Eisenhower years and the boom years of the 1950s. On the other side, this could be the 1930s. We could be looking at a prolonged hit to the global economy, which, as we all know, in the 1930s, the Great Depression then was the Lounge Act for the Second World War. That is the worst case scenario. And it's not unthinkable at this standpoint. What I can say with a high degree of confidence is that this is going to lead into a ramp up of the Second Cold War. This time, instead of the Soviet Union, it's going to be the Communist Chinese. So as you see on the next slide, this can only have a deleterious impact to demand. Here in the United States, the summer is over. The demand is over. The demand has been killed in the cradle. So this were estimates by the Federal Reserve Bank of St. Louis, and this was done back in February when there were still 163 million Americans in the workforce. On this estimate, they're projecting potentially 47 million people being laid off in the second quarter. We just had the weekly numbers today come out from the Bureau of Labor Statistics on a weekly basis. 36.5 million Americans have already lost their job. And of course, that transcends over into Canada as well. When we can see on the next slide, 164.5 million Americans were in the labor force in February. On these estimates, at 53 million unemployed, that was the 5 million unemployed plus the estimate of 47 million, we're looking at 32% unemployment. So as we move forward, I'm going to jump ahead on a couple of slides. So please advance the slides. One more. Okay. Nearly 50% of Americans are out of work. The same number transcends into Canada. Next slide, please. Next slide. More. So, two more. So what we're looking at here is a contraction in GDP here in the United States. The contraction in the first quarter was 4.7%. But based on the factory order numbers and the BLS numbers from the last week and a half, we're looking at here a pullback in contraction in the first quarter, not a 4.7%, but when you adjust for the latest numbers, when the GDP numbers come out next estimate for Q1, we're looking at a likely 7, perhaps 8% contraction in the first quarter. That's a recession. The 35-36% contraction that the Federal Reserve Bank of St. Louis is calling for, or the 39% contraction that the Congressional Budget Office is calling for, as we've said, that is no longer a recession. That is a depression. And that is going to have a long-lasting impact on demand for energy. So this isn't a V-shaped recovery we can expect for both Canadian and US consumers. This is demand that's been destroyed, not coming back, and we're looking at 2 to 3 years before we get back to levels that we were just a few months ago. Move forward, please. Okay, more. So now we're working here. Okay, great. So now what we're looking at here is the inversion in the forward curve in the Brent market. So right now we have to keep in mind that there seems to be, especially on the consumer level, an indication that that red line in this graph in the Brent forward curve going out 1.5 years, 2 years is somehow a bullish prediction. That is to say prices are moving higher into the future. That is incorrect. Commodity markets are not anticipatory markets. That is to say, we can't discount cash flows, make estimates of demand destruction today, and discount that going forward and come up with a price forecast. Commodity prices are priced in the spot market. We're looking at a market now that is well oversupplied. So here in the United States, we're looking at a market where US exports are no longer competitive on the global market. If US exports are no longer competitive, this is only going to serve to back up demand further for Canadian producers and maintain the glut for Canadian prices and the sector. So right now we've taken out demand destruction, or demand production, I should say, of record 13.1 million barrels a day in the United States back in March to last week 11.6 million barrels a day. That's good, but it's not good enough. Canadian production has fallen 644,000 barrels a day on estimates going up to 1 million barrels a day. That's good, but producers need to cut more. They need to cut more because supply destruction is continuing to outpace demand. Demand destruction, excuse me, I had that backwards. Demand destruction continues to outpace supply destruction. So as demand continues to fall, and as we go forward, again, this is another indication of that glut of demand overwhelming supply here in the United States, as well in Canada. And we're looking at now the US and Canadian producers now potentially testing capacity. Here in the United States, we're at, for all intents and purposes, capacity at the NYMEX hub. Now, we've had some headlines over the past week and a half in Canada. Enbridge is decommissioning their line 3 off of their main line, but they're going to make that available for, I believe, the next 8 or 9 months to lease out 900,000 barrels of space to alleviate some of the capacity constraints there. Here in the United States, what we saw yesterday, 9 US oil companies have leased 23 million barrels of space in the Strategic Petroleum Reserve, thereby alleviating the capacity constraints at the NYMEX delivery hub. But that doesn't mean we're out of the woods. That just means we are shifting the deck chairs around on a self-made Titanic that North American oil producers have put themselves in over the past 3-4 years. So I want to quickly address the prices going negative on the NYMEX at last month's expiration, because now there seems to be an indication, because open interest in the June contract, which expires next week, is also extremely high. Don't think we'll see negative prices. The reason why we saw negative prices last month was because we had small retail investors taking outside long positions in this market. In the 2 weeks prior to the May expiration, small retail investors, that's not hedgers, that's not Canadian Natural, that's not ConocoPhillips, so forth. We were talking doctors and dentists with disposable income. They owned or accounted for 11% of the market's length going into the expiration. They have by no means, of course, to store oil. So holding 52,000 contracts of length, they simply couldn't liquidate, holding on to that position going into the final 2 days. And hence, when no one wanted to buy it because no one could store it, you get prices plunging to minus $40 a barrel. Now keep in mind, I do not expect to see prices go negative this time around. That doesn't mean prices are necessarily going higher. We're looking at jet fuel demand here in North America, and this is the United States. It's over. The summer's dead. It's been killed in the cradle. It's dead on arrival. So there is virtually no jet fuel demand this summer. Same goes for gasoline demand. Again, 37 million Americans and Canadians unemployed. That's a lot of commuters that aren't going to be commuting to jobs. And those of us who are still fortunate to have jobs for the better part of the summer are going to still be working from home. Again, keeping commuter cars off the road. And with tens of millions of people on both sides of the border unemployed, they're not going to have a lot of disposable income to vacation. So gasoline demand is not going to rebound this summer. It's not going to rebound next year, probably not going to rebound for the next 2 to 3 years. When we look at the historical analogs, when we came out of the recession in the mid-1970s, and we hit the double dip recession and deindustrialization in the markets in the early 1980s, what we saw was a significant decoupling in the growth in gasoline demand, well off the seasonally adjusted models that existed from measured demand growth from 1975 to 1980. As we can see, demand growth for gasoline did not return to 1979 levels until 1986. So it did not return to pre-recession levels until 4 years after the end of the recession. So what is this going to mean for pricing for both US and Canadian companies? And what does this potentially mean for pricing? Can you advance the slide and take down that video, please? Okay, so at this point, this is what US producers need to see. At a minimum, to keep wells open, $23 a barrel, that's down in the Eagle Ford, up to $36 a barrel on the high end. That's just to keep producers existing wells. So naturally, we've seen a sharp pullback in production or in well counts. To open up a new well, you need to see $50 a barrel. That makes sense. PDVSA, state-owned oil company of Mexico, the largest oil hedging entity in the world, announced in January that they had locked in 2020 production at $49 a barrel. There's your price. When a country like Mexico, a country like Canada, they're telling you this is what Mexico needs, this is what the US producer needs, this is what the Canadian producer needs to remain competitive. So when we look at here, we're no longer competitive. We had the minus $40 print on the expiration last month. Oil prices, WTI NYMEX, are well below $30 a barrel. Canadian Natural, Canada's largest oil and gas producer, says they need oil at WTI $30 to $31 a barrel. So we're a solid $5, $6 a barrel below what both North American producers, the upper 2/3, need to see. Now, unfortunately, it does not look like they're well hedged. So of course, we're getting sharp pullbacks in rig counts. This is the rig counts of New Mexico and Texas. And these are the two states that comprise the Eagle Ford, or the Eagle Ford. So we're seeing now a pullback in rig counts and the corresponding pullback in production, but that has to continue, and that will continue. The same with the pullback in natural gas. So I'm just going to advance the slides, and these are the final two slides, and we can open it up for some questions. So at this point, we're looking at a survey that was conducted in the Federal Reserve Bank's 11th district, that is the state of Texas, parts of Louisiana, parts of New Mexico, the United States oil patch. And when 153 executives at oil and gas service companies and E&P companies were asked about their headcount from last December to this December, more than half were expecting a pullback in headcounts going into the end of the year. And mind you, these surveys were taken when oil prices, WTI, were still trading at $40 a barrel. The Dallas Fed also went ahead and asked how long you'll stay in business at $40 a barrel. 15% of the respondents said they'll be out of business by the end of this year with oil at $40 a barrel. Another 25% gave it a 1 to 2 year time frame. That was $15 ago. So 15% of U.S. oil and gas companies cannot exist at $40 a barrel. We have to at least double that at $25 a barrel. So going ahead, it's a chicken and egg contest. If you're a consumer and you have the wherewithal to hedge, you ought to be locking up as much energy, as much natural gas, as much crude oil, as much petroleum product at these levels that you can maintain on your balance sheets. But the problem here is that oil prices are cheap for a reason. There's an old adage on Wall Street that low prices aren't the cure for low prices. We certainly have low prices. This is presenting on the consumer side, on both the Canadian and the US consumer side, a tremendous opportunity to hedge long-term fixed costs at these levels. The problem is that we're still in economic doldrums. We're in a depression now. That depression is going to last into the summer. Some on Wall Street believe we're going to see a V-shaped recovery. I'm not one of those people. I don't see a V-shaped recovery when 15% unemployment is going to be the norm now going into next year. So hopefully this will be a U-shaped recovery. It's going to last at least this quarter, probably into the third quarter, perhaps through the end of the year before we can actually count on demand returning to the market. And when that demand does return to the market, be it in the third quarter, let's hope I'm wrong, or maybe in the first quarter of next year, demand will not return to levels based on the analogs of past history for 2 to 3 years out. So hedge accordingly, hedge your needs if you're buying at these levels. But keep in mind that demand is going to be challenged through at least the end of the year and likely into 2021. So, do we have questions?
Hi, Stephen. Yes, thanks. We have some questions that have popped up. First one I'll give you is a pretty kind of general one for you to comment on. What can the energy industry do to help lead recovery when that time comes?
The energy industry is doing what it can do. There is this misnomer out there that low prices spur demand. Commodity prices do not create economic activity. Economic activity creates energy prices or commodity prices. So the pullbacks that we're seeing in energy prices, the same types of pullbacks we are seeing in the agricultural markets, in the industrial metal complex, and so forth. The industry has already been doing a tremendous job to address the needs. We saw the pullback here in the United States in prices in 2015. Now, unfortunately, the U.S. energy industry is in a difficult spot now, because what the banks did in 2015 was extend the slack in the noose by extending the credit. That credit is now coming due in 2020 through 2022. So we're looking at U.S. oil companies, large oil companies, debt to equity ratios of perhaps 30 cents on the dollar, not optimal. So the energy can continue to begin to pay down the debt. For the Canadian producer, in a much more dire position. The Canadian producer never really, because of the logistics of being on the far end of the pipe, never fully recovered from the doldrums of the pullback in energy prices in 2015. So the debt to equity ratio for your largest oil and gas producers in Canada is closer to 49 cents on the dollar, so considerably more than what the U.S. is producing. So pay down the debt, continue to pay down the debt, and the industry is doing, as we said, it's pulling back production. But the energy industry can only address the supply side, and both Canadian and U.S. industries are, and that's the beauty of publicly owned companies. They're not beholden to the government whims to the greater extent. So they're doing what they're doing now by addressing the supply side. They have to sit and wait to see how the demand side responds over the next 6 to 12 months.
Okay, thank you. So we've got another question, actually a couple of questions from a gentleman who actually works in the greenhouse industry with us here. He works on the floral side. He's just wondering where both natural gas and, I guess by association, electricity pricing is likely to go kind of the rest of this year and through 2021 and 2022. Might be a big order to kind of give all that, but if you can comment on that.
Oh, no, sure. So natural gas prices, of course, have been in a perpetual bear market. Commercial and industrial demand was lagging going back to the end of last summer. For the most part, Canadian and US markets had an extremely mild winter, which has led to a glut in gas, which has, of course, depressed prices tremendously. When we look ahead to this summer with protocols on both sides of the border, you're going to see an unprecedented spike in demand for residential use of electricity. So supporting the market there. So you'll see a disconnect in the market because although residential demand for both power and natural gas is going to spike to levels that were just unthinkable a year ago, with this many people either unemployed or still working from their homes, is going to be muted by the lack of commercial industrial demand. So they're already, for instance, in Germany, I mean, it's May. They've already canceled Oktoberfest. They're already, we don't even know if we're going to have a Major League Baseball season. We don't even know what the NFL, the NHL, the NBA, their seasons are over. We don't even know what the fall is going to look like. So when we're looking at amusement parks, shopping malls, corporate office parks, all shuttered, that lack of demand on the commercial industrial side will be greatly offset the spike in demand. So from a greenhouse standpoint, from an electricity standpoint, it's an interesting phenomenon here because the pullback in oil prices and the massive pullback in crude oil production here in the United States is having a tremendous impact on natural gas potentially. Because your second largest producing field here in the United States was a crude oil field in Eagle Ford. So with all that crude oil production, record crude oil production, you get record amounts of associated gas coming up just based on the geology. But of course, that production is falling and associated production for natural gas is going to fall. So at this standpoint, we're already starting to see pullback in demand here in Pennsylvania. For instance, gas prices in Pennsylvania gas permits in Pennsylvania have dropped now to the lowest level since 1995. So that is the Marcellus, that is the Utica Shale gas, which has a tremendous impact on the flows going into Sarnia in gas prices in southern Ontario. So we're starting to see some support here. But I venture, and we do here at Schork customized hedging programs for commercial and industrial users. And what we've been discussing now with all of our C&I users, you can lock in, forget about oil prices, that at $1.60 decatherm natural gas on the NYMEX, $1.70 decatherm, you're nuts, absolutely nuts not to be locking in gas at this level. So going forward to so we run our estimates going out for the next 3 years. We model this based on the quantitative models, but based on our volatility estimates. And so there are tremendous opportunities depending on which market, whether you're in Alberta, whether you're in Ontario, so forth, in the Sarnia petrochemical market, or in Hamilton in the steel market, your use, depending on the years. We are modeling this, and they're presenting tremendous opportunities to lock in at given times a year. But that is something that is, and we certainly invite people to contact us. And we can run through these programs.
Okay, excellent, thank you. If you have time for one more question, I've got, so would the future of oil and gas companies, would the future for those companies be a bit more hopeful or do you think there's an opportunity for some of those companies to kind of start transitioning into renewable energy in some areas, just to kind of maybe kind of comment on that?
Yeah, absolutely. I'll try. So what we're going to see both here in the United States and Canada is a much smaller market from a participation standpoint over the next 2 years. So with the amount of debt coming due here in the United States, some estimates had it at 150 billion, that's billion with a B, maturing over the next 2 years. And the adage on Wall Street is they're not willing to extend credit anymore. They want the paybacks. So when we're starting to see this, some of our larger clients, the BPs, the Shells of the world, they're already transitioning, and so to renewables and more towards natural gas. So for instance, Shell stopped referring to itself as an oil company 10 years ago, referring itself as a natural gas company. Now it's an energy company as it transitions into the power side. BP's going the same way. The US oil companies, Canadian oil companies, they are transitioning. So certainly this is a factor of both economics, of government fiat, of the younger generation wanting a different BTU to burn to generate electricity. So certainly what you'll see is what I expect to see, that is to say, a significant consolidation as the small producers. A good number of them are not going to be around over the next year, but they're still sitting on good acreage. They're going to be bought for pennies on the dollar. So the Exxons, the BPs, Cenovas, so forth, are going to be in the potential to acquire. So you're going to see a much smaller on the oil side. Natural gas side, we're still very bullish long-term out. That is the future, as are renewables. So certainly we're already moving in that direction with your largest traditional oil companies already calling themselves natural gas companies and already interested over the next 2 generations, so within the next 50 years, of being renewable companies. So this will certainly help propagate that move going forward.
Excellent. Thank you so much for your insights and the information you've given us today, Stephen. I think you gave us a lot of good insights to what's going on here and where the future is going. I know sometimes it's definitely not looking quite as bright in the immediate future, but yeah, it's very good to kind of hear just kind of your outlook on where we're going. So very much appreciate your time today, sir.
Thank you, Julie. I appreciate the opportunity.
Okay. Well, thanks very much, everybody, for attending today. Please do feel free to follow up if you have any other questions that you'd like to come back to us. Feel free to just kind of reply to the invites that you got, and we'll get those emails. So without any further ado, thanks, everybody, and thanks again, Stephen, and hope you all have a good day.